Okay, I just understand we are live. Thanks everyone for joining this panel. And I apologize because of some technical difficulties. You can hear my voice, but you can't see my face, so you will have an invisible moderator. So I hope that works out and we still will have a good discussion. But welcome in the afternoon's panel of Amsterdam FinTech Week, where we will zoom in on the investor side, their appetite in investing in fintechs. And so the aim that we have really with this panel is to give you more insights where investors are putting their euros, and also what we thought was really interesting for the audience, to hear how they experienced COVID-19 and the initial impact, how it changed their views, and how they at this moment are looking at the fintech investment world post COVID-19. So we have a really great panel, so we can discuss all the stages of investments. So we go from early stage to IPO. And in that context, Holland FinTech did a really great job. So they lined up a fantastic panel with very esteemed investors. And I just wanted to kick it off with a quick round of introductions so you know who's talking to you. So if I can ask Edward from Ventures One to kick it off. And tell a bit about your firm, yourself, and also with an eye on the stages that you invest in.
Hi, everybody. My name is Edward. I've been an entrepreneur myself, been active in the financial, legal, and insurance industry. Last year, I exited my company, Omni Bridgeway, which is now quoted on the Australian stock exchange. For the past 20 years, I've also been investing in all kinds of companies and quite a few fintech companies as well. I do that through Ventures One, of which I'm founder and CEO. We have an office in Holland and in Singapore, and these are also the areas we focus on. Thank you.
Great, a man with experience. Then let's move to Thierry from Finch.
Yes, hello everyone. So maybe a quick introduction about Finch. So this is a Dutch fund headquartered in Amsterdam with offices in London and in Jakarta. The reason why we're set up that way is because we invest throughout Europe and Southeast Asia. We invest in everything what we call fintech and deep tech, focusing on everything which is Series A. We typically lead, have been in the market since 2013, and currently operating on the third fund. Myself, I've been now with the team since 2.5 years, covering everything which is continental Europe. And as a background, I was a founder myself, worked at Deliveroo and at Cedars before joining the venture.
Great, that's a nice profile as well. Great. Pauline from BlackFin Venture Funds.
I think you're mute,
Pauline? So we...
It's not working.
Yeah, let's go to Harrie from Rabobank.
Yeah, thanks. Hello, everyone. I'm Harrie Vollaard, heading the corporate investment arm of Rabobank called Rabobank Ventures. It's an early stage investor in fintech as well as agri-tech, and that of course relates to the background of the Rabobank, which is a global leader in the food and agri space. We are now 3.5 years out there. We have done 23 investments so far, and we invest on a global basis.
And also because you're liaised to Rabobank, are you sort of a corporate venture fund, as you can call it, where you have to also look at the benefit of the investments that you do to the wider Rabobank organization?
Yeah, so what we try to do is facilitate a two-way street. So early stage investing is a long-term play. So we are looking for opportunities which change the market and can play a role in 5 to 10 years time. So in that way, it's more a learning exercise for the Rabobank itself. So that's the one way. And of course, what we try to do is leverage the assets of the Rabobank towards our portfolio companies. And it can be anything, you know, getting access to the distribution channels of the bank or getting technical expertise on topics.
Clear. Thanks. Shall we try Pauline again?
Can you hear me now?
Good.
Great. Let's go again. Sorry about that. So I'm Pauline, FinTech. BlackFin is a fintech-focused VC fund. We're leading C to Series B rounds across Europe. So far, we have a portfolio of pretty much 12 companies across Europe and a few in the Netherlands as well. Myself, I've been working in fintech venture capital for the past 4 years, mostly on the other side of the Atlantic for 3 years, and I joined BlackFin just under a year ago. Before that, my background is mostly in banking, so here I am.
Good, fantastic. And then let's move to Patrick Lemmens from Robeco.
Yes, hi, good afternoon, everybody. I come from Robeco. Manage 2 funds, one of which is a fintech fund, which is right now 1.1 billion. We move around in the listed market, but we're also looking right now at becoming invested pre-IPO as anchor investor, and perhaps even before that, but that's still to be decided. But yeah, very clearly in the listed domain, I've been doing financials, global financials, fintech for over 25 years now. ABN AMRO for 15 years, and now for the last 12 years at Robeco.
Great, thanks for the intro, Patrick. Okay, and just a quick introduction on myself. I'm CJ Welkzijn, and I'm leading. And so we are a specialized investment bank that focuses on fundraisings. Also series more B than A, going up to pre-IPO stage and IPOs itself. So that in terms of introductions, then in terms of housekeeping comments, if you want to ask questions, I understand you can type them in and we'll keep an eye on them. And after the panel, there's also the possibility to hang around directly, and that goes on the left-hand side of the column. So let's kick it off, and why don't we start a bit on the black side and ask the panelists, you know, how they started at 2020 with a bright outlook of what's going to happen, and how they were suddenly confronted with COVID-19. And how they dealt with the initial stages. So let's just start from the beginning again. Edward, where were you and what happened?
Yeah, well, we are an early stage investor, so we do a lot of startups and early scale-ups. And as such, for us, it's quite important to meet the management team, and COVID obviously made that extremely difficult. So basically what we have done is further support the companies we already had in our portfolio, but we did not add on any new investments as an early stage investor. For us, the management team is a key asset of the company, and we would like to see them in the eyes and not through Zoom or Skype, but preferably live. And that has been difficult.
Yeah. And what about you, Thierry? Were you did you see COVID-19 coming in the sense that you could prepare your pipeline and the deals you were executing and your portfolio companies a couple of weeks before, or?
I think I would like to meet the person who would have foreseen COVID to happen. But overall, I think it was a shock to everyone. Luckily, we are in a phase where there is there wasn't any drama from a portfolio perspective. So we were not investing in any travel companies or entertainment businesses that literally saw businesses like from a revenue perspective go to zero. So obviously we stopped sourcing at least for quite a while, and were actively on the board trying to restructure companies, and others, they were actually doing extremely well, that benefited a lot through the crisis, such as broker or like investment brokers or even insurance companies. They just benefited a lot through the crisis and saw record months after record months. So it's a mixed bag, to be honest.
Yeah. Yeah. And Pauline, on your side, how did you?
Yeah, so it was pretty similar to what Thierry just mentioned, and Edward as well, in the sense that it was a surprise to everyone. No one really knew it was coming. So the way we started 2020 was we were targeting a number of deals. This year we were planning for a pipeline for the rest of the year, and obviously when it hit, we were not that prepared, and so we had a few deals that started, so we closed them, but we didn't start anything new for a couple of months. We refocused on the portfolio a lot. It was really important for us to run a lot of scenarios to understand what was the cash position of every single company, and help them as much as we can. Interestingly enough, a few companies, so none of the companies didn't like crash, as Thierry mentioned. We invest in fintech, so like yes, we're not the most touched, but a few segments did pretty well over the past few months, especially during the lockdown. Few companies operating in payment, for example, or in SME cash flow forecasting did actually very well. So that was not expected. It was kind of a boost for them. So that was the beginning of the COVID-19 for us.
Yeah. Excellent. And Harrie, on your side?
Yeah, I was actually on a business trip last February in India when we heard some rumors out of China talking about certain cases, COVID cases, etc., etc. But and I thought, something is going to happen, but I didn't realize that it would have such a big impact. So when we came back, a couple of weeks later, we run into this lockdown in the Netherlands. But first of all, you need to spend time on your portfolio companies to see if they're doing okay, as every single investor will see what the real impact is of COVID on the business. And especially the ones who are actually in the middle of a fundraiser, that you need to look at them more carefully, because as we all know, the investment pace slowed down. So you really need to look after and see if you could actually extend their runway. So cash is king in these days. And interesting enough, we have, of course, fintech companies as well, agri-tech companies, and you would say, this is the primary sector. So, but even though they were exempted from the government, in many ways they were still hurt by all kind of border limits, channels, access to workforce. So also we were very busy with agri-tech related companies to help them out in setting their focus on extending the runway.
Yeah. And Patrick, you're obviously working in the listed market, and you probably saw the first reactions, and then suddenly it went very fast. How was it for you?
Yeah, indeed, there is no escaping in the listed markets. So you get an immediate impact. It's immediately visible. In that sense, I can sometimes be a bit jealous
in private equity or venture capital. I mean, that is at least not going so fast, although, but of course, what you do see is end of quarter markdowns and all that stuff. So that's not something you can escape. We were, well, relatively quickly, we came out with an analysis by our trends team, looking at what is going to be the impact and what would happen. Fortunately, we were well positioned in both portfolios, both my financials fund and also the fintech fund. So we actually came through March reasonably well. And since then we actually been surprised about how incredibly quickly and immensely the digitization trend has accelerated. But I guess we will spend some time on that later as well.
Yeah, but it's an interesting point, because in my experience, we saw a lot of private equity players becoming a bit careful, whilst your market was at one point really collapsing. And the private equity, and with private equity I also include venture capital, etc. They were all looking also at the equity markets to see if it would sort of stabilize. And what we would say normally in the equity markets, you would see rescue issues, which sort of create new pricing levels in the market, but that hasn't really happened, I think. And there was lots of governments putting their funding, or how you say, their facilities in place, and the market sort of traded up. But can you give some more color, Patrick, on how you looked at the markets, the equity markets, in the first couple of months, when things, and I can hear you did well with your funds, but levels went down.
Yeah, sure. It's always strange, right? I mean, you are outperforming relatively versus whatever benchmark you use, but at the same time, your clients are losing money and your fund valuations are going down. But I mean, when we approached half March already, that started bouncing back again. So actually, the pain was relatively quickly going away again, although it took a little while before we were back to where we've been. And some banks, for example, have never really come back. Interestingly, already early days put actually money into private equity firms we invest in, like KKR and Apollo and Carlyle, because we've thought that this is actually going to be a great opportunity. I mean, if you got dry powder right now, you can literally sort of strike. That is, of course, going to take time. So we saw it more as an opportunity, because this is not a crisis like 2008, when there was a real problem in the financial markets with the banks. This is, say, a disease which is really awful, and we are all trying to make it better. But it's not the banks doing wrong things or people in the economy. So in that sense, I think. I think we were more optimistic on that we will bounce back, and of course it's going to be tough to will ultimately pay for all the money we are spending right now, which has to be invested, but still remain actually optimistic, and surely optimistic on fintech, because if anything, opportunities there have actually increased, in some cases tremendously.
Yeah. And if I asked the other panelists who are acting on the private side, were you concerned on valuation levels initially, and how fast did that sort of change again when you saw that the market was turning around faster than you probably expected? Edwards, yeah.
No, we were not really worried about the valuations, at least not in our own portfolio. We have a long-term investment strategy, so we're not too worried in short-term bumps. In general, you can see that valuations have softened a bit. But as fintech will continue to be a major item in the next couple of years, I don't think, that it will be a continuous drop in valuations.
Yeah. And Pauline, how did you guys at BlackFin look at it? Were you initially very concerned that valuations would go down, exits more difficult?
Yes and no, in the sense that we didn't have any much issues in our portfolio, but when looking at new deals, actually, we were very careful because we didn't know what was going to happen and for how long. So definitely, I mean, when you invest in venture capital, you invest in growth. Ultimately, you don't invest in technology, right? You invest in growth, and the company is not able to grow as quickly as possible. Then obviously the valuation is going to be impacted. So yes, we were thinking about how we can adjust valuations to reflect the current situation in the new deals that we could look at in the future. When we look at it now, then we don't see a lot of adjustments, but it could have happened. So we were thinking about how this could reflect in the valuations. There's two ways to adjust for the current situation. It's just one, valuation, and two is terms. And we've seen investors adjusting for the current situation in terms, offering what we can say maybe not like friendly or founder friendly kind of terms. And we're not really like big fan of these, but so we could have adjusted for valuations and it didn't happen, but we could have, and some investors adjusted on terms. I think that's my answer.
Yeah. And if you look at your portfolio, are there, because you're doing fintech, can you see a difference between the performance of the various fintechs that you have? Because I understand you have a good portfolio, you didn't have any bleeders, but are there certain sectors, subsectors,
that are doing pretty well, and some were more impacted than others, definitely. So we have, for example, we have a company in our portfolio that is a B2C company. It's pretty much a mortgage broker, an online mortgage broker. Obviously, during the 3 months of lockdown, no transaction happened in real estate. So it was hard for them. Now they catched up because the activity goes up like very fast, but it was hard for them for 3 months. On the other side of the spectrum, we have a company that is developing a cash flow forecasting tool for SMEs. And these products, so their demand exploding, like it literally boomed, and this company is doing pretty well. Just because, as you mentioned earlier, I think it was Harrie that mentioned that cash is king for every single company, especially SMEs. So now that you realize that you need to look at your cash and be careful with it, a lot of SMEs subscribe to this kind of software. So yes, some companies did better than others. Ultimately, they're all back to kind of normal level of growth, and thankfully, we're not that much impacted.
Yeah, and so if I can add something to the discussion, what I noticed, the high performers, the top growth companies, they're still oversubscribed. So there's no issue there. So that's one. And I see what I noticed as well, especially in the challenger bank space, is more focused on unit economics. So that's another thing. And especially in the business-to-business market, I see a slowdown in the business, and that makes sense. It's just hard to do physical meetings, so you see longer sales cycles. So what usually happens then is that the deals we are looking into, well, of course this has impact on their business. So what they try to do is just extend their runway and see if they can come out of COVID and then improve and go back to their performance pre-COVID, and then going into fundraise, because otherwise they will be afraid that they will adjustment on the evaluation.
Yeah, and Harrie, that's an interesting topic. So so have you done like sort of bridge financing for your companies, and can you perhaps elaborate a little bit more on what kind of structures that you've been using? Have you been using convertibles, or you just put in new equity?
Usually via bridge.
Yeah. And how's that? I'm not sure if Thierry is still on.
Yeah, I'm still here. May I ask the other panelists to maybe mute themselves, because
let's ask the others. Like Edward, have you also provided emergency financing to portfolio companies?
Sorry, I missed the question.
Hello.
So in the COVID period, where you had some of your portfolio companies that perhaps were running out of cash, have you provided emergency financing?
Yeah, we had to bridge quite a few companies because they were all in the growth stage. As I said, we are early stage, so normally these companies grow very fast, and COVID has been very negatively impacting their cash flows. So we did quite a few extra convertibles to finance them, both in fintech and in insurtech, where we are quite active.
Can you hear me now?
Yeah.
To give one example, I mean, we participate in a company doing that's actually an insurtech company, but it's quite a good example. They do a lot of business in China, in the car industry. Car sales in China went down with 85% early in the year, and their business in China dropped by 70%. So you can imagine that they needed some finance to overcome this issue.
Yeah. And Thierry, have you also been doing emergency or rescue issues for your company portfolio?
Yeah. So if we look across our portfolio companies, those that were generally impacted were those that were selling to financial institutions. So a common trend that we saw there was that some financial institutions were doubling down on tech and they were leapfrogging, but they tend to be the financial institutions that even before COVID were already like more open for digitalization, and we just saw the ones that were just more cautious about it were just increasing the gap between technology and themselves, right? So we then saw that basically companies needed 6 months burn. Thankfully, thankfully that's still to be determined, but there were a lot of governmental aids. The Netherlands, for example, the UK, Germany, which were very generous in terms of what they offered from a package point of view in order to match your investment. We leveraged the UK, the Dutch, and the German one in order to do so, but also included new investment onto the cap table. It was just to increase the amount of funding volume in order to increase as much as possible.
Yeah. And is there a view from the panel, just to close it off, the COVID-19 period, on were these government aid packages attractive, and were they easily accessible? What was your experience in general?
So for us, I can for our portfolio. We have a portfolio that is pretty much spread across Europe, and a lot of the countries played a really nice role in funding these companies in the UK, in the Netherlands, in France, and Belgium, like pretty much everywhere in Europe. It was a lot of money that was distributed pretty quickly. So they did like an amazing job. So that would be my feedback, that they did an amazing job in issuing these grants or loans. I have to say that, for example, in France, we have a feedback, which is it was easy for startups to access these fundings when you have a relationship with the banker already. And when the companies have only a neobank account, for example, with like a Quanto or this kind of banks, I don't know if you know them, then it's hard for them to access this kind of funding. So a lot of the companies needed a relationship with a banker, with a traditional bank that has started before COVID. So that would be my feedback. It was hard to access from fintechs. It came with a second wave and not the first wave of grants.
Yeah.
Yeah, so from our side was quite positive and easy. Our only fear is that these governmental packages just kick the can further down the hallway. And I don't think that we have yet witnessed the real slap of the implications of Corona. We expect that this will hit sometimes in H1 2021. Once the steam is off and the governments, they do not have enough financing in order to do a second bailout, so to speak. I mean, at the end of the day, it's their responsibility also to keep stability and to keep employees employed. So in that sense, it was a right choice. Just the question might be, could they have been more stricter to which companies they gave the money to? That is up to discussion.
Yeah. But perhaps that's a nice link in how you guys have been coming out of the lockdown, and you look into a slightly brighter future, and you make this comment that's from kicking the can down the road. But if I can start with you, how do you look at 2020? How are we going to end this year, and how will next year look? And how do you look at the will there be a new vaccine, for example? Obviously, you won't know, but if that would come, how would that change the market for your company, portfolio companies?
I think the market changed in the sense that incumbents realize that they actually can be innovative and can adopt new solutions quite rapidly. I mean, they made the most unthinkable things, such as working completely from remote, all the teams via different tools, which if you would have said that 6 months back, I think people would say, yeah, we would need 2 years maybe to do that. And here they did it in less than a month or so. And that's maybe where they realized, okay, maybe now is the time for us to press the gas and really buckle up our tech stack. And so we expect that there will be a lot of action from an M&A perspective, meaning that more deals will happen, but the volume sizes will decrease drastically, meaning that we will be looking at a lot of exits between 50 to 150 million in order to acquire tech. Meaning the road to IPO will become way more difficult because these companies will never really attain their full capacity before they will receive a sweet offer. So in that sense, we position ourselves again. We were rethinking about our positioning in the market on how much ownership we should have in the company in order really to also bring back the money towards our investors. So it's maybe not completely answering your question, but at the end of the day, when crises were happening, the biggest companies were founded, right? Such as Facebook and other players. So you will definitely see winners emerge during those times.
Yeah. Hey, and how do you look at that? Do you see opportunities in 2020 still, and how do you look at 2021?
Yeah, we are actually well on target. So we in the beginning of this year we said we like to do 8 deals, and we have done 6 deals so far. So in performance we're doing quite well. But I think COVID or post-COVID, it actually more accelerates the trends we are already seeing. So there is after the debacle of WeWork, there's a more focus on unit economics. And that's more prevalent today. And the other thing is that there's also more tendency towards business-to-business propositions, and investors try to shy away a little bit from business to consumer because it's a lot of marketing effort, as what you already have seen in the challenger bank market. So. And I think it just accelerates the trends we are already seeing. So going to business as well, more focus on realistic business models and unit economics and showing the right performance metrics. And next to that, as what Thierry is saying, well, there is a lot of additional urge to digitize at the incumbents level. So you see that already reflected in the RegTech space. So there was immediate need for all kind of RegTech solutions, email, know your customer, or whatsoever. So a huge uptake there. So I expect also an increase in collaboration between fintechs and incumbents. And I think, although, you know, I think a lot of, especially early stage companies are suffering, especially when this is going to take another 6 or 12 months. So I also expect some inorganic growth to happen, not only from fintechs who are, you know, try to accelerate, but also from incumbents who, you know, think we really need to boost our innovation roadmap. So instead of trying to figure out everything by yourself or creating a collaborationship, it's better to acquire fintechs.
Yeah, yeah. And Edward, do you see that danger that if it takes a bit longer and that some of your early stage investments are getting under pressure and might have to sell?
Well, until now, we have managed to keep all the investments alive, and we are pretty sure that we are safe until first quarter of next year. So we do hope, obviously, not only for us, but for everybody, that there is a vaccine by then. I keep on saying that we will not do new deals until we have seen the management team. So that is basically stopping new investments until we can really travel again. Yeah, basically our primary focus is on the investments we have.
Yeah, yeah. And if I move to Pauline and I would ask her, like, you know, are you looking for your portfolio companies at interesting other companies to acquire and to expand their growth?
Yeah, I think it's kind of an opportunistic approach in a sense that this is not specifically what we are looking for at the moment. If the situation is and we find an interesting target, then why not? For now, it's not the priority. Fundraising wise, what we're expecting in the next year or so is. So as this has been mentioned by a lot of panelists already, you invest at seed level, you invest in people more than anything else, and you have really nothing to show. So we expect a lot of more local deals at seed levels. So where we have roots on the ground, like feet on the ground, we can invest at seed level. When we cannot meet with the founding team, that what we start to see is some syndication in deals, and we expect this to continue a bit longer. When you have a local fund that is willing to share the deal with another seed fund that is not actually very local, but you know, we're expecting this to continue to happen. At A and B levels, it's a bit different because now you have KPIs to show and you have gross numbers that you've demonstrated. So we're seeing good deals getting a lot of money, and the valuation continuing to be to the roof. We've seen a few deals this month, and even a B2C one, Harrie, that got a lot of money, a lot of attention at a huge valuation. But my point is, there's a lot of money on the market, so I totally expect this money to flow to the ecosystem over the next year or so. And it's just that the structuration is going to be a bit different.
Yeah, yeah, clear. And if we move to Patrick, because you're at the end of the spectrum. When companies should have grown and you know, are mature enough to go to the public markets, can you shed some more color on how you look at the market ending this year and going into next year? Do you see more IPOs happening? More appetite?
Yes. Well, first of all, what we as I said, right, we initially looked at what kind of trends are now changing because of COVID and what's happening. We already pretty quickly concluded that the digitization would be much faster of everything, and including financial services. And the only thing I can say, it's gone even faster than I could have imagined. If you look at some of the investments we have in Argen and they had better numbers than even the markets were thinking they could deliver. So that has gone very fast. What you're now seeing is that some companies were left behind, which still have quite decent profiting from these digitization trends. So those we are sort of also taking up now. But what I also found interesting, and that sort of goes back to what Thierry was already saying, is that some of the banks actually who were not digitally going into this, digitally prepared going into this crisis, they've had real trouble sort of making that sort of, changes which they really need to make now to core IT systems. And that's why I actually see some interesting longer term opportunity. On the one hand, banks which are prepared and which are now increasing the pace of digitization, and then the ones which are basically, should have done their work already 1 year, 2 years ago, but really have to get to it. And then there's of course the question of which IT companies, which fintechs will profit from that. We've got quite a few investments in that space. And then we're coming to the issue of IPOs. Yes, absolutely, we expect more IPOs to come. We already participated in 2 this month. But it's going to be interesting because IPOs tend to, you tend to get some of the really hot, popular IPOs. I mean, if it's cloud, then it's of course hot, and then it's crazy. I mean, it's difficult to get even allocation. And that's also another reason why we are trying to move earlier and earlier in the investment space phase, trying to, be involved as early as possible.
Yeah, let's touch base on that later on. Yeah, because I think, we were both involved on the Unified Post transaction. And you from the investing side and we from the underwriting side. And I think it was also there, testament how eager investors were to get their hands on these shares. And I think, it also made clear to us again, what a limited choice investors have in the public market to invest in digital, and especially in Europe. But I think also there, the combination of cloud and SME was sort of the trigger. But do you see?
Just to ask as a simple question, there was a huge appetite in Unified Post, or it wasn't?
Well, there were 6 corner investors already taking up more than half of the deal, so that helped, I think. And then I think within 10 minutes of the deal launching, it was already fully subscribed across the range. So
because that's also in line what we've seen with what's going in with the investment brokers. So a huge uptake there. Because a lot of opportunistic behavior when the market goes down, people think, well, this is maybe also a chance to step in. So a lot of investment brokers are actually outperforming the market and doing better than ever expected.
Yeah, exactly. That's a good example. But you react on that, Patrick? Sorry.
Into things for a longer term, right? I mean, I actually am looking at what is Unified Post doing today, because I hadn't really looked at it today, and it's a bit down, and the volumes are not very high. So we tend to get into stuff for the longer term. We liked the story behind Unified Post, which is sort of the European Bill.com, and if they can produce the same kind of revenues which Bill.com does, and they actually do make a profit, then I think it could become a very interesting investment for us. I think there will be more deals. There will be some very hot deals, and then I actually would prefer to get into the ones which are perhaps not super hot and therefore immediately on day one priced quite highly, but the ones which maybe not everybody is looking at, and which are still quite long-term attractive and interesting to invest in.
Yeah. Hey, and going back to Thierry, do you guys look at the IPO market as well? I mean, you're more early stage, so I guess you're looking at the Series C and D investors to join your companies. But does the equity market play a role in your outlook?
Yeah, absolutely. But like I mentioned before, we do have a big sense that actually the road to IPO is going to be way more challenging. We believe that there are going to be way more mergers between companies. Maybe that will help them to gain enough traction or from a tech stack and value chain proposition to actually gain to the point that they have the right metrics in order to go IPO. But we do believe really strongly that there is going to be a shift in the M&A transaction. Also, that there is not going to be like these mega rounds like we have seen before. I think in the US this will still prevail, but in Europe we will more see exits between 50 to 200 million. So in that sense, as a VC, you will have to position yourselves quite nicely on the cap table in order to make sense to the model that you're currently exercising.
Yeah. Good. If we then talk about valuation expectations in general, I think it matters to all of you. Who wants to kick it off in terms of what do you expect in terms of valuations next year? Are they will they be holding up? Or... It
depends really on sector by sector. Talking now about IPO, if you look at the challenger banks, they're getting a big slap in the face. They're perhaps the sector that received the most financing with the most berserk valuations. And from an exit point of view, no bank is going to acquire them because at the end of the day, let's face it, it's a consolidation of technology. So there's no true uniqueness in the tech except the nice user experience and the UX you have for your mobile. And the clients, well, you cannot put such a big multiple in order to reach the billions. So there I expect to have quite a significant haircut in that industry, because and they have to focus on other types of revenue streams. They have to repivot their business model in order to start having positive unit economics. So have maybe more premium features, maybe start going into lending, etc., etc. So we definitely see some sectors that will decrease in valuation, such as travel and all these industries, entertainment. But those that will prevail and continue to grow are definitely the KYC, AML type of companies, payment, and even any company that kind of enables fintech or incumbents to be more productive, like the UI paths of this world.
Yeah. And how is that for you, Pauline? What do you expect in terms of valuations?
Yeah, I think I touched a bit on that point in the previous question, in the sense that it's going to be different for different type of companies. I foresee kind of deals. I totally expect it to remain the same. It's just for Series A or B that already have things to show, things to demonstrate. There's going to be a lot of competition on these deals, and the valuation are gonna increase, or I mean, at least that's what we've seen since the lockdown, actually. Depending on the stage and on the quality of the risking aspects that you can show on your pitch deck, this is definitely something that we're seeing. And to come back to Thierry's point on the neobank, that's quite an interesting point. What is happening at the moment to them is they are burning so much cash and they are so big at the moment. They all needed to get some more money during the lockdown. They all got refinanced, even the winner Revolut at the moment. And yet they're like growing like crazy, and Kaim just raised at like 14.5 billion valuation. It's huge, and it's probably too late for any M&A transaction at that point. So like, not sure what's going to happen to them, but we expect a lot of cleaning here from consolidation perspective, or from just banks that are dying. Monzo is not in a good shape, for example. And there's definitely, we're seeing more and more of these like smaller banks, maybe tier 2 or tier 3 that are not winners, that are flying to profitability. And I think it's Starting Bank that is targeting that at the moment, and Tandem is targeting that at the moment as well in the UK. They're all flying to profitability because it's not the level of cash burn is not sustainable. Anyway, so to come back to valuations, my comment is mostly on stage and not on development stage and not on industry.
Yeah. But I want to pick up on the Revolut one because that's an interesting one for Patrick, I think. So too big for M&A. I guess you would agree, Harrie. So then you go to potentially a listing. Would you invest in a company like Revolut, Patrick? And what would be your concerns potentially?
Well, very generally, I mean, as I'm not allowed to talk about specific one-name companies, but I mean, I want companies to be profitable or have a credible plan to reach profitability within a reasonable time period, and that would not be like 5-6 years, but I mean, clearly sooner. And I am not convinced that a lot of the challenger robo advisors are able to get there. So I mean, and unless of course I'm proven wrong, we're not going to put our money into that.
And do you believe, because in your market we have seen the SPACs, that's something that's happening in the US more often. Mm-hmm. Do you see that as a good alternative for these kind of, or is it already too large for those?
Well, I mean, it's an interesting one, right? I mean, so basically I would be giving our fund money away to somebody else who's going to run a sort of a fund, you could argue, I mean, acquiring stuff. And I think we can do a better job ourselves. We can pick the companies ourselves and make the investments rather than having somebody else do it for us. When you do not know where they're going to invest and how successful they're going to be. Of course, they can show, I've got this or that track record. I've done that other fund before, but no, I find it. I do see these companies coming around, and one additional problem is that they tend to be not large enough often for us to invest in, because quite generally you could argue that we need roughly $1 billion at least in market cap, and some reasonable liquidity. Because if we make an investment, the minimum size is going to be 10 million, and if we continue to grow with our fund, we have to be mindful that taking a minimum 1% position implies in the future 30 million of investments. So we already take into account today when we make investments in companies whether we can invest at some stage 30 million. So But I mean, the economics, I mean, you're basically putting your money into something you don't know how it's going to be. You can't check. Well, I mean, you only can hope and trust the person who are the people who are going to run it, that they'll do a good job.
Yeah. And could, as a question from Don, I see, could SPACs become an alternative for VCs?
That's for me. Well, I don't. I think VCs are better equipped, I think, to make these investments, having, existing portfolios, existing track records, rather than just going out to the public market and then hoping that some people will give you some money. I don't know. I think, but I mean, I think perhaps it's more interesting to put this question to the other people.
Yeah, well, we are more on the VC side of course. I do think it is more difficult for startups to get money, and that automatically will also influence the valuation, at least in the short term. So although there is lots of money available in the market, I see that also venture capitalists are more careful in investing. And that's basically what I said before. That's what we're doing as well. I mean, we are more careful in choosing new targets, more focusing on our own portfolio, which we already have. And I think if you are a startup these days, that you need to be more aggressive to find money than before.
Yeah, so there's less money available for you, for your companies, you argue.
Yeah.
Good. Okay, let's also talk a little bit about deal making for the audience, because that's also an interesting development, that everyone works remotely. And perhaps, Harrie, what has been your experience so far? Have you already done your first fully remote and virtual investment?
Yeah, we expect to close one in 1 week time, coming out of Africa, so also a challenging continent. But what our strategy is going forward, especially when you're talking about the emerging market, but in general we are working in syndicates. We step in on Series E or Series B and onwards, and I think the best way, actually also for the portfolio companies, is to work in syndicates where you have a financial investor next to a strategic investors like we are, and we prefer to have a local financial lead investor where we co-invest alongside with them, so that it takes a lot of risk out the investment itself. And next to the direct investments we are doing, we have done some fund investments, which helps us also out in getting high quality deal flow. And of course, we are backed by the Rabobank, and the Rabobank has people all around the globe. That's also very helpful in assessing the right deals. And lastly, we had already a healthy pipeline, so we are still managing the pipeline. So sometimes the startups reach out too early. They need to show some additional traction. So we continue the conversation. So I think some of the investments which are going to happen in the nearby future are based on the pipeline we have built in the last couple of years.
Yeah. And Thierry, have you already thought about how you create your pipeline going forward? Because I guess you will be in the same position as Harrie. You will have done a lot of work building up your pipeline in the past, but now you might come to the stage where you're really going to meet new companies or have to meet new companies, and you cannot just travel around.
Yeah, absolutely. So actually, it's funny that you asked that, because during the confinement, we built an internal tool which helps us sourcing, which basically scrapes a lot of data sets with a couple of how can I say criteria that we put in place. And although it takes a large chunk away of manual work, we then cross-reference them and reach out then via LinkedIn. So it became more of a desktop job than before, scouting people on events. However, this gives us a good overview in order not to miss some deals if we apply the tool correctly and allocate the right amount of time to it. But at the end of the day, if we're really interested in making a deal, we will make sure that we meet the team. I mean, obviously during the confinement, no one was allowed to go out, and I think there was nobody was thinking about doing deals, but more how am I going to help my portfolio companies? Just to give you an idea, so we did one deal 2 months back. We are about to do another deal, and we just jumped into a car, just drove for 6 hours, met with the team, spent the night, and came back. I mean, where there is a will, there is a way. And like Edward said, it's very difficult for us to do something completely remote. especially because we're lead investors and we sit on the cap table with a very, you know, we basically built a company together with the people. So we want to make sure that, you know, you're entering into a bond of like a wedding. So you want to make sure that you're partnering up with the right people.
Yeah, yeah. And Pauline, I guess, you know, also BlackFin will rely more on data, similar to Finch from Thierry. But have you had other means of connecting with companies, or do you still like visit these kind of events, for example, or virtual? Is it easier, more difficult?
So virtual events are harder to meet with companies because you just like can't have a coffee or run into someone and just like chat for 5 minutes. So it's harder. We are as well developing an internal tool that is pretty much databased that allows us to track companies and target better. And we have to do it that way because face-to-face like events are not producing the same kind of outcome anymore. So we have to like adjust and do it another way, and definitely database approach is what we're going for. We've always have been, but we are more open to cold emails, I would say, and looking into pretty much everything. Like basically you're doing everything that you were not able to do before because you didn't have the time to do it. So we're doing it better while putting a lot of efforts in the database approach. We 2 days ago, we just closed our second deal post lockdown. But the second deal, I mean, for both deals were deals where we have been able to meet with the founders before. We met with them at the previous round, so we knew them before, and it's even better because we were able to track their progress and see what happened in the past. We value progress a lot, and then that was easier. We're comfortable investing in them. We are entering now sheet phase with the new companies where we didn't have the chance to meet with the founder at the moment. It's hard, and we're still like figuring it out how we can adjust our processes. It's making more ref calls. It's making like a lot of different things. We're trying to. We're still figuring it out, and we would be way more comfortable if we could meet with them at some point. And hopefully this can happen before the term sheet. So, long story short.
If you look, and the question to also the whole panel, but if you know, what's the most difficult part of the whole deal making process, from sourcing to closing? Mm-hmm. Where do you really need to be at the table with the founder? I get, you know, you could argue it could be sourcing because you want to have the initial feel, but it could also be negotiations that you want to be sort of in one room.
I think that the Zoom conversations are really, really efficient. They're way more efficient than they used to be. Everyone is used to that, so it's better, especially for the negotiation part. Definitely for the sourcing, it's not only meeting with the founders, it's meeting with people, interacting, be part of the ecosystem, hear about what's going on. Hey, have you heard about that company? They're raising it, like, you know, just like chit-chatting about everything that's going on. For the closing, yes, definitely. But before the closing, I would say taking the investment decision. You need to see the people. You need to see if there's a fit. You need to see if there can be some trust. Like, you know, you want to see what's going on. You want to feel it. So I would say, yes, the sourcing is hard, but it's not only meeting with the founder directly. It's the founder comes at the investment decision kind of step for me.
Yeah, yeah. And Patrick, because you're working already completely virtual, I think, with equity roadshows, you have invested now in companies you have not met in person.
Yep.
That was a sin before March. And I don't think there was any equity investor that would invest without seeing a company on the public side. How do you view that?
Well, there's been dramatic change, right? I mean, if you do look at this, there's two angles, right? I mean, the angle of ourselves and how we are dealing with companies now. And I have met with my team over the past 2 weeks, 70 companies with 5 different conferences from Hong Kong to San Francisco. So that's sort of what's happening, and then in the time zone, not physically. So that's really improved, and that's easy. And 6 months ago, I didn't think that would happen. So that's definitely going on. I mean, what we miss is being in the office together and being able to talk and exchange thoughts quickly. and therefore we are now coming back to the office twice a week with the team to make sure that we don't lose that connection. Although, of course, on a daily basis we have continuous contact. Then, if you look actually at the companies, it's interesting, right? I mean, you see that a lot of companies are now looking at how they can easier and better sell to the customers, and that's, I think, something which is interesting, right? I mean, you've got, for example, bank technology companies which are now really, selling stuff online without meeting the banks, without having contact with them, sort of physically. But so we do see a change now with the companies we invest in, trying to become more digital, trying to be also able to sell online rather than being meeting physically.
Yeah. Guys, I see that we already run a minute over time. I would just want to close off the panel with a last question to all of you. Invest more or less next year? And what do you think is the main change that you will see going into 2021 in terms of deal making? Harrie, I see you're looking and thinking. Can I start with you?
Well, I'm a little conscious about the time, to be honest, but anyways, just keep it short. I will continue to invest with the same space. And what my critical questions towards the existing companies is, how did you actually deal with COVID? Was it what kind of flexibility did you show to mitigate your the impact you have seen on the business of COVID? So that would be my most important question.
Yeah. Good, thanks. Edward, you gonna invest more?
Yeah, well, we are likely to invest the same as last year and this year, but more in existing portfolio than in new companies. The biggest change in investment in new companies is probably that we will partner with more local people. That's also what Harrie said, that because traveling will still be difficult, and we want to meet a team that we will likely, if we invest in new companies, we will partner with a local investor who can really meet the team.
Yeah, clear. Pauline?
Yes, I think same pace. We have a fund to deploy, and there's a lot of very interesting and exciting opportunities out there. We are figuring it out how we can on a few other criterias. Be more selective, or anyway, we're still figuring our secret sauce out, but we are going to continue to invest in new companies, and that's what we're paid for, and that's what we like to do. So we'll continue to do so.
Great. And Thierry?
Yeah, so same from our side. We will still be aggressive on the market and be present. I think the thing that might change from our side is that we are thematic investors, but even be more thematic in the sense that we will have more of a top-bottom approach. So see what the INGs of this world would be very likely to acquire, and work ourselves down in order to figure out, okay, this is the subsector. How much can we buy ourselves in? What would be the type of valuation at where they would go out? In order this to make sense, we need to have 20, 30, 40, 50, 60% ownership in order for this to happen. So yeah. Again, based on the discussion we had on the shift in M&A.
Yeah, fair. And Patrick?
I think there are great investment opportunities in fintech, and I hope that the people who invest in our fund will continue to put money with us and give us more money to make that happen.
That sounds like a good closing comment. Hey, then I think there has been actually given a very optimistic outlook for 2020. I think it's the word optimistic. but also cautious, and it will have an effect on deal making. And I like the emphasis on connecting with the locals to making sure that there's some kind of a connection where you can rely on in your investment process. But for all panel, thanks so much for your time. I thank you very much, and thank you to the audience as well.
Great.
Thank you.
Everyone.
Thank you.